This was not just another red day. This was not one of those sessions where you shrug, blame profit-taking, and tell yourself everything will look better by Monday. This was the kind of market action that forces people to stop pretending they understand the tape and start admitting that one thing is moving almost everything. Right now, that thing is oil. Because when oil starts pushing into the danger zone, stocks do not just drift lower. They lose their footing. Bond yields stop being background noise. Inflation fears stop being theoretical. Traders stop caring about polished headlines and start looking for one thing only, and that is a real solution. Not a calming post, not a vague promise, not a nice sentence thrown into the news cycle to buy a few hours. Before we go deeper, if you get value from the work I put into these breakdowns, subscribe and leave a quick comment, even if it is just Our John AG. It helps more than most people realize, and it tells the algorithm this kind of straight analysis matters. And by the time you are watching this, the members-only video should already be up as well, where I put the full update in one place and go much deeper on the moving pieces. That is also the easiest way for me to see who is really following closely when the market gets fast and the headlines start flying. Now let me set the table properly, because tonight is not about pretending the market is broken forever, and it is not about acting like one headline fixes everything. It is about understanding what actually hit risk assets, what bounced, what held up better than feared, what is getting close to levels that matter, and why the next big move may not look anything like the last few sessions. Because this is where people get trapped. They see a market falling for days, and they assume the next move has to be down. Or they see one diplomatic headline cross the screen, and they assume the bottom is already in. Usually, both groups are early, and in a tape like this, being early is expensive. So let's start with the thing that matters most. Not the spin, not the noise, not the recycled talking points about resilience. Oil. As of Friday's close, the S&P 500 finished at 6,368.85, down 1.67%. The Nasdaq closed at 20,948.36, down 2.15%. And U.S. crude settled at $99.64, while the 10-year Treasury yield sat around 4.44%. Official U.S. CPI for February was 2.4% year over year, which matters because it tells you the 7 to 10% inflation talk is not today's reality. It is a fear about where things could go if energy stays high and the pressure spreads. That is the first big point, at least for now. The market is not reacting to current inflation as if it already exploded. The market is reacting to the possibility that oil can drag the next inflation wave higher before policymakers have any clean way to respond. Because when traders looked at the latest attempt to calm nerves, they did not see certainty. They saw delay. They saw a lack of details. And markets, especially stressed markets, do not reward ambiguity for very long. That is why a lot of people felt confused. They saw a headline that sounded calming. They expected futures to stabilize. They expected buyers to step in. But the buyers did not show up in force, because the market is no longer asking for a softer tone. It is asking for something concrete around the Strait of Hormuz, shipping risk, and the broader path of supply. Until there is something real there, the market keeps interpreting high oil as a threat to growth, a threat to sentiment, and a threat to future inflation. And once that mindset sets in, the sell-off stops looking random. Then the intraday action starts making sense. You saw it in the broad market. You saw it in the bond market. You saw it in the way big tech could not catch its breath. You saw it in the way every tiny uptick in crude seemed to lean on stocks again. That is not a coincidence. That is the market simplifying the entire story into one input. Oil up, risk down. Oil backs off, bids come in. Not always perfectly, not every minute, but close enough that you ignore it at your own risk. Now here's where I want to slow down, because this is the part that most people mess up in real time. Just because oil is the driver right now does not mean every asset has the same roadmap. That is lazy analysis. And lazy analysis is how people buy the wrong thing at the wrong time for the wrong reason. The bigger picture on the S&P still looks vulnerable to me. I still think there is room for this market to work lower over time, and the 6,100 area remains a reasonable, bigger picture destination if the stress keeps feeding on itself, and if a real resolution does not arrive soon. But that does not mean the market has to travel there in a straight line. In fact, markets almost never move that cleanly when fear gets this concentrated. They overshoot, they snap back, they punish late sellers, then they test nerves again. That is why the worst mistake right now is thinking only in one direction. If you are long-term bearish, you still have to respect the possibility of a violent relief rally. And if you are trying to buy a bounce, you still have to remember that a bounce is not the same thing as a full reset. Those are two completely different trades. One is tactical, the other is emotional. And emotional trades are usually the ones that blow up. So when I say I can still see lower levels ahead on the bigger map, that is not the same thing as saying every stock should be dumped right now with both hands. There are assets that are getting stretched enough to bounce hard if the pressure eases even a little. That is where this gets interesting, because if the market finally gets an actual breakthrough, not a rumor, not a maybe, not a hopeful sentence that means 6 different things depending on who is reading it, but something traders can treat as real progress, then the rebound could be much sharper than most people expect. Why? Because fear has already done a lot of the setup. It has already pushed people out. It has already created urgency. It has already made traders very sensitive to any sign that the worst-case path might not happen immediately. And when a market gets that one-sided, you can get what traders call a rip-your-face-off rally without changing the larger bearish case at all. That is what people struggle with. They think a violent rally means the market was healthy all along. No. Sometimes a violent rally simply means positioning got too extreme, sentiment got too heavy, and the trigger finally arrived. That is why I keep saying the key variable is not whether people want to bounce. Of course they want to bounce. The key variable is whether the market gets the kind of development that lets buyers act without feeling like they are stepping in front of an active train. And right now, that still points us back to oil. Oil is the center of the entire argument. And here's the twist that makes this even more important. A market can be right about the danger in the short run and still be wrong about the longer run. Oil can stay elevated long enough to hurt stocks, pressure yields, and keep everyone tense, while still forming a structure that eventually rolls over hard once the catalyst changes. That is why I think you have to separate the near-term damage from the bigger chart. Near-term, high oil is clearly a problem. But longer-term, I do not think that means oil has to stay in charge forever. If anything, the very pressure created by higher prices increases the odds that policymakers, producers, and markets all start pushing towards some form of adjustment. And if that happens, crude can fall quickly. That matters because it changes everything downstream. Lower oil would ease some inflation pressure. Lower inflation pressure would take stress off bond yields. And if yields calm down, the market suddenly gets breathing room it does not have right now. That does not magically fix all valuations. It does not repair every broken chart. But it changes the emotional temperature, and that alone can fuel a serious counter-trend move. This is why I think a lot of people are too simplistic right now. They are either saying, the market is doomed, sell everything, or they are saying, this is the dip, buy with no fear. I do not think either one is disciplined enough. The better approach is to ask, which assets are closest to meaningful levels if the market gets relief, and which ones still look vulnerable even if a bounce arrives? That brings us to the leaders that got hit. Let's talk about the names everyone watches first, because if you want to understand sentiment, you have to understand what is happening in the biggest growth names. Nvidia ended Friday around 167.52. Microsoft closed near 356.77. Meta finished near 525.72. Rigetti closed around 1332. Bitcoin traded near 66,779, while Henry Hub natural gas was around 294 for the week, and natural gas futures were hovering near the 310 area traders were watching. Now, do not hear those numbers and assume I am saying every one of those assets is safe. I am not. I am saying they are getting close to places where traders start asking a different question. Not, is this perfect? But, is the downside already crowded enough that a bounce can become tradable? That is the right question in this kind of tape. Take Nvidia. A breakdown is a breakdown. Once a major name loses important structure, you do not just pretend the weakness never happened. That is how people get trapped in love with a stock that is not acting right. And that is why any recovery in a name like that may run into trouble around resistance instead of moving straight back to where it came from. That is important, because people keep doing this thing where they see a stock down hard, then automatically imagine a full round trip back to the highs. That is fantasy. A damaged leader can absolutely bounce, and sometimes bounce hard, without proving the long-term damage is repaired. Those are not the same event. So with a name like Nvidia, I am not interested in pretending the breakdown never occurred. I am interested in whether fear got stretched enough that a shorter-term rebound becomes attractive if the market gets even one clean reason to breathe. Meta is similar, but in a slightly different way. It has been hit hard enough that support zones start mattering again. Not because support is magic, not because lines on a chart create miracles, but because large pools of demand often live near areas where price previously moved violently. And when markets get oversold, those zones become magnets for traders looking for snapbacks. That does not mean Meta cannot go lower later. It can. In fact, I think there is a very real chance that some of these names bounce first and still revisit lower areas down the line if the bigger market path remains weak. That is another point people hate hearing. They want one clean answer. Bottom or no bottom. Bullish or bearish. All clear or all danger. But real markets are messier than that. A stock can be attractive for a trade and still unattractive as a long-term hold at the exact same moment. Microsoft is a good example of that kind of tension. When a stock that size drops that much in a relatively short period, the first thing that matters is not whether the company is dead. It is whether the move got stretched enough to attract responsive buyers if the broader pressure backs off. That is where tactical trading lives. You are not marrying the name. You are not building a shrine to it. You are asking one simple question. If fear loosens, how hard can this thing bounce? And this is where discipline matters more than opinion. Because once you admit you are playing for a bounce instead of a new bull run, your decisions get cleaner. Entries get cleaner, targets get cleaner, stops get cleaner, expectations get cleaner. That matters most in the smaller, more volatile names. Look at Rigetti. That kind of stock is exactly where fear becomes extreme enough to create explosive upside if the market catches even a short burst of oxygen. But that same volatility is also why people lose their minds with position size and turn a good idea into a terrible trade. And this is where I want to make a broader point. The market right now is punishing impatience more than bad intelligence. A lot of smart people are getting hurt simply because they cannot wait for levels, cannot size correctly, or cannot separate a tactical trade from a big emotional prediction. That is why beaten down names can still be interesting even in a weak market. Not because the world is suddenly fixed, but because markets move in waves, and stretched names can rebound violently before the bigger trend is settled. If you are experienced, that is an opportunity. If you are impulsive, that is a trap. Big difference. Let me explain why vague reassurance keeps failing, because this part is easy to miss if you only read the headline and never watch the reaction. A market under normal stress can calm down on tone alone. A market under energy stress usually cannot. Why? Because traders can live with uncertainty when the cost of uncertainty is still manageable. But when the uncertainty is tied to fuel, shipping, inflation expectations, and the possibility that yields stay high longer than people want, a soft message does not remove the problem. It just delays the next question. And once traders realize the message did not change the actual path of supply risk, they go right back to selling what they do not want to hold through the uncertainty. That is why this week felt so heavy. The market did not just decline. It traded like it had lost confidence in words. That is a very specific kind of weakness. And you could see it in the way the broad market behaved intraday. Instead of opening weak, finding a floor, and building a bounce, the tape kept leaning lower with very little energy from buyers. It tells you dip buyers are either exhausted, cautious, or waiting for something better than a guess. When the market spends most of the day struggling to put together even a decent rebound, that is usually not just random ugliness. That is hesitation from people who normally would step in faster. There is a message in that. It says confidence is damaged. Not destroyed forever, but damaged enough that it takes more than habit to bring money back in. And then there is the dollar. I do not think enough people are paying attention to how the dollar fits into this whole stress picture. A firmer dollar on top of higher yields and higher oil is a nasty mix for a lot of risk assets. It tightens financial conditions without anybody having to announce some dramatic new policy. It just makes the whole environment feel less forgiving. So even if the dollar is near an area where it can run into resistance again, the broader point still stands. When too many pressure points start moving in the wrong direction at the same time, equities feel it fast. That is why I keep resisting easy answers, because there are multiple weights on the market right now. Oil is the headline weight, yields are the financial weight, the dollar is the pressure amplifier, and sentiment is the emotional fuel making all of it feel worse. Take one of those weights away, and the market can stabilize. Take two away, and you can get a strong rebound. Leave them all in place, and every little bounce starts feeling weak and temporary. Now let's talk about the kind of rally people should be ready for if something finally breaks the tension. Because a lot of viewers hear relief rally and think I mean some quiet move higher over a week. That is not what I mean. I mean the kind of rally that feels unfair if you sold at the lows. The kind of rally that makes people say, how is this up so much when the world still looks messy? The answer is because markets move on change, not perfection. If traders go from pricing a worsening path to pricing a less bad path, that alone can be enough. Stocks do not need a perfect ending to rally. They only need a meaningful reduction in fear. That is why some of the ugliest markets can produce some of the sharpest upside days. The bounce is not about joy. It is about pressure releasing. That is also why I would be careful with anyone who speaks in absolutes right now. Anyone saying this must collapse immediately from here could get punished by one headline. Anyone saying the coast is clear could get punished by the next spike in oil. This is a reaction market, and reaction markets reward flexibility. If you are too attached to one story, the tape embarrasses you quickly. So the discipline right now is not just about finding the right level. It is about staying mentally loose enough to admit when the market's driver has changed. And once it changes, you shift. You do not argue with it. You do not negotiate with it. You shift. That is the mentality that protects both traders and investors when the board starts moving fast. Now let's move away from tech for a second, because one of the most interesting parts of this market has been what happened in the traditional fear trades. Gold finally looked more like a risk-off asset again. On Friday, spot gold jumped to about 4,491.78 an ounce, while silver rose to roughly 69.54. That matters. Not because one day changes the whole story, but because in recent stress, precious metals had not always behaved the way frightened investors expected. There were moments when liquidity pressure, rate fears, and forced selling made those markets act less like shelter and more like collateral damage. So when gold starts stabilizing and responding more like a defensive asset again, you pay attention. That does not mean gold has bottomed forever. It does not mean silver cannot wobble again. But it does tell you that fear may finally be finding the places people thought it would find much earlier. Silver is the trickier one. It can bounce strongly, and it often does, but it also has a habit of reminding people that volatility cuts both ways. A move up does not automatically mean the path is clean. It may simply mean the metal is responding to oversold conditions, headline stress, or a shift in dollar and rate expectations. Bitcoin is another really interesting case here. A lot of people want it to be one thing all the time, either digital gold or just another risk asset. The truth is, in moments like this, it can trade with the mood of broader markets, while still holding up better than people expect if key levels remain intact. That is why I am not eager to declare it broken just because fear hit the tape. If panic starts easing and risk appetite comes back, Bitcoin is one of the first places that can move fast. And that is exactly why so many people mishandle it. They wait until it is already running to decide they believe again. By then, the easy part of the move is gone. Now, let me bring yields back into this, because ignoring the bond market right now would be a huge mistake. The 10-year yield around 4.44 is not just a number floating on a screen. It is part of the pressure system sitting on top of equities, mortgages, refinancing needs, and policy decisions. Reuters and other market coverage this week showed investors demanding higher compensation as war-driven energy fears pushed inflation worries back into the conversation, while reports also highlighted that the U.S. faces roughly $9 trillion of debt refinancing within about a year. That is not a small detail. That is one of the reasons the bond market matters so much here. When yields rise in a calm growth K environment, markets can sometimes absorb it. When yields rise because oil is high, inflation fears are creeping up, and policy clarity is missing, that is a much nastier mix. Because then the market starts thinking, what exactly is the clean release valve here? Can the Fed help quickly? Not easily, if inflation fears are reaccelerating. Can growth stay strong enough to ignore the pressure? Maybe for a while, but that becomes harder as energy feeds through the system. Can investors simply look through the problem? Not when oil is acting like the daily scoreboard. That is why this entire setup feels tight. Too much oil pressure and you aggravate inflation fears. Too much inflation fear and yields stay elevated. Elevated yields lean on valuations. Weak valuations hurt stocks. Falling stocks worsen sentiment. And once sentiment gets weak enough, the market starts selling first and asking better questions later. That is the loop. Now here's the upside case hidden inside the downside case. If oil breaks lower in a meaningful way, that loop can start working in reverse. Inflation fears cool, yields calm, equities get room to breathe. Oversold leaders bounce, crypto catches a bid. Even the names that looked broken can suddenly feel very alive for a few sessions. That is why I keep coming back to the same phrase, watch the driver. Not because nothing else matters, but because right now, that is the shortest path to understanding everything else. And this is also where a lot of viewers can help each other. If you are one of the people who has actually learned how to stay calm in ugly markets, share that in the comments once in a while. Somebody newer is probably reading, probably stressed, and probably needs to hear how discipline looks from someone who has already been through a few of these storms. Because that is the other thing panic does. It makes people feel alone in mistakes that are actually very common. Now let's talk strategy, not just market theory. If you are chasing every red candle lower right now, you are probably late. If you are buying blindly just because something fell, you are also probably early. So what is the middle ground? The middle ground is waiting for levels, respecting catalysts, and knowing exactly what kind of trade you are taking before you click anything. Are you buying Microsoft because you believe the whole market has reset and a new leg higher is starting? Or are you buying because you think a stock that has been crushed is due for a technical rebound if oil cools off and sentiment eases for a week? Those are different trades, different targets, different holding periods, different risk. Same ticker, different mindset. The same thing goes for Meta. The same thing goes for Bitcoin. The same thing goes for smaller, high beta names. And it definitely applies to oil itself. Because one of the more aggressive ideas in this whole setup is the thought that oil can still be shortable into strength if the larger pattern eventually rolls over. That is not a beginner trade. That is not the kind of thing you do carelessly. But I understand why that idea exists. If crude is being driven up by stress and fear now, and if that stress is what eventually forces some response, then the market may be building the very conditions that later break crude back down. That is the irony. The more oil hurts, the more pressure builds for something to change. Now, I do want to make one thing very clear. None of this means the market owes anyone a bounce on Monday. It does not. The market does not care what feels fair. It does not care how oversold a stock looks on your screen. It does not care how badly people want a green candle after several ugly sessions. It moves when the inputs change, or when positioning gets so extreme that even a small shift creates a rush. That is why weekend headlines matter so much right now, because the next meaningful move may come from a change in perceived risk, not from some perfect technical pattern appearing in a vacuum. If futures open Sunday night and traders think the path around supply risk is improving, you could see a very sharp reaction. If they think the uncertainty is just being dragged out again, then the pressure can continue, and all the "it has to bounce now" arguments will sound just as foolish as they did a day earlier. So yes, I think there are assets entering accumulation zones for traders. No, I do not think that means the bigger bearish path is dead. Yes, I think gold looked better. Yes, I think Bitcoin can still act better than some people fear. Yes, I think natural gas is one of those side markets worth watching because once a wedge resolves, it can move faster than casual traders expect. And yes, I think oil is still the master variable. That is the cleanest way to frame the whole board. One market is setting the tone. Everything else is adjusting around it. If you understand that, the chaos starts looking a lot less chaotic. And if you ignore it, every move starts feeling random. That is why I wanted to do this video this way. Not as a list of tickers, not as a bunch of disconnected charts, but as one connected story. High oil has the market on edge. That edge is feeding yield pressure and valuation stress. That stress is crushing sentiment. The crushing of sentiment is creating tactical opportunities in beaten down names. And those tactical opportunities can become very powerful very quickly if the driver finally reverses. That is the whole map. Simple to say. Very hard to trade if you are emotional. And that is where I will leave you with the practical part. Do not confuse a tradable bounce with a permanent bottom. Do not confuse a scary headline with a final outcome. Do not confuse current CPI with the market's fear of future CPI. Do not confuse a damaged chart with a useless asset. And do not confuse being aggressive with being reckless. Those mistakes all sound similar in a market like this, but they cost money in very different ways. If you made it this far, tell me in the comments which market you are watching closest right now. Oil, the S&P, gold, Bitcoin, or one of the oversold tech names. And if you are someone who has had success by staying patient when everyone else was panicking, share that too, because those comments help more people than you think. The market is tense, but tension cuts both ways. That is the part people forget. Fear creates damage. Fear also creates setups. Your job is not to predict every candle. Your job is to understand the pressure, wait for your levels, and act like someone who knows the difference between panic and opportunity. That is how you survive a tape like this. And that is how you stay ready for the move that catches everybody who got too comfortable with only one direction.